Okay, this video is going to be on how business owners can use defined benefit pension plans to save thousands in taxes every single year. Now, I realize that the idea of establishing a plan that promises to pay your employees retirement benefits every single month after they stop working for you for the rest of their lives, and having the obligation to fund a plan like that probably isn't the most palatable idea. But if you don't have any employees, it can be a great way to put a whole lot more away tax deferred than you can in a traditional qualified defined contribution plan like a 401k. For example, in 2017, the maximum amount you can put into a qualified defined contribution plan is $54,000. That's nice, but if you're getting a late start in saving for your retirement, you're a high income earner, maybe in your 50s, you might want to put away more than $54,000 a year for your own retirement. There are no contribution limits in defined benefit plans. The only limits are the amount of benefits that you receive every year after you retire. And in 2017, that's $215,000 a year. Okay, here's how defined benefit plans work. First step is to establish a plan document. That's the document that describes how the plan works, what the eligibility requirements are, and what the benefits you get for working for the company for X number of years will be after you retire. That's required since defined benefit plans are considered qualified in the eyes of the IRS and qualify for these special tax treatments. So once you establish those standards, and if you have employees, you need to consider what the financial impact of allowing them into the plan in year 2 versus year 5 would be, and offering them $50,000 in benefits versus $100,000 in benefits. There's a lot of considerations you need to make if you have employees. But if you don't, all you need to do is figure out how much you want the plan to pay you after you stop working. What happens next is you turn it over to an administrator or an actuary. And what they do is they figure out, well, if you want to be paid $100,000 in defined benefits from this plan every year after you die, that means that between now and then you're going to need to put in X number of dollars. And they run actuarial calculations based on the expected growth rate between now and when you retire, the expected growth rate after you retire, and your life expectancy. And then the actuary comes back every single year and says, based on how fast this account has grown, you're going to need to put in this amount of dollars to the plan every single year. If you get great investment growth in the plan in year 1, that means that in year 2, you're not going to have to fund it with as much dollars because the growth exceeded expectations. But if it lagged expectations and didn't grow as fast, or maybe depreciated because the market crashed, you're going to be obligated to make up that difference with the contributions the following year. So that's a drawback of defined benefit plans. They're not going to show any mercy in years where the market crashes or you have bad investment performance, or if the economy shrinks and your business goes through a slump. You're still going to be required to put in the correct amount based on the actuarial assumptions the following year, and sometimes that can put pressure on business owners. But the benefits are too hard to ignore. And if you're getting a late start on saving for retirement, you can put in whatever dollar amount it takes to give you up to $215,000 a year in retirement benefits. That's in 2017 after you stop working. So for people who are getting a late start on retirement savings, maybe you're in your 50s, you're trying to defer taxes, this can be a great way to catch up because all these contributions that we're talking about are deductible. Now, if you're younger, you're in your 30s or 40s, defined benefit plans, since you need to hire the actuary and do all these other things, there are higher operating costs than there are in defined contribution plans. And for that reason, they really only make sense for people who are a little bit closer to retirement, who are trying to make up for lost time. If you're in your 30s or your 40s, you're probably better off starting with a lower cost defined contribution plan like a 401k or a SEP IRA, and then maybe graduating to a defined benefit plan when you're a little bit older if you want to. Okay, last point I'll make about defined benefit plans is that you really need to be committed to making a high annual contribution for at least 5 to 7 years. Because if you're interested in putting away, say, $30,000 or $40,000 a year tax deferred for your retirement, that's great, but you're probably better off doing it in like a 401k or maybe a SEP IRA, defined contribution plan, that has more flexibility and lower operating costs. If you want to put away more than the annual limit, which again is in 2017 $54,000, a defined benefit plan might be a better option because you can put away a high amount of money for a shorter period of time, and by doing so and not being subject to any kind of annual contribution limit, you can really save thousands of dollars in taxes by doing that. But you have to be able to do it for at least 5 to 7 years in order for the math to work out. And like anything, any retirement plan, defined contribution, defined benefit, whatever, needs to be coordinated with your aggregate financial plan and investment and retirement strategy. If you haven't done so already, be sure to check out our short video series on 3 easy ways business owners can reduce taxes. Just click this link to watch.